Hey guys, welcome to the podcast. Thanks for joining me. I appreciate it. Today is Tuesday, the first trading day of the week. Of course, the market was closed yesterday for President's Day. And we come back today. You can see a picture of what the stock market did. Really, it opened up, and then, of course, down we went. Had a little bit of up at the end of the day, but still closed kind of flat to mostly down, depending on which market that you looked at. You can see overall the Dow Jones Industrials was up this morning quite a bit. Of course, surpassed 13,000, big psychological level. Then it was down 20 or 30 points. Finished up almost 16, as you can see there. The S&P was up fractionally, and the Russell 2000 was down, as was the Nasdaq. But the big story of the day was the transports. You can see 5163.18 down 76 points. That's 1.46%. Big reason for that, of course, was oil, which we'll get to in just a minute. But first, I want to bring up a chart. I think I showed you this the other day. I know I did it in a blog. I'm not sure if I did it on the podcast or not. But we're showing the fact that the transports going down is sometimes an early indicator. As you can see here, when it broke this, and remember, this is a relative strength between the transports and the S&P 500. So when the transports start underperforming, you see this line going down. When the transports are outperforming, you can see it going up. So it broke in mid-July, and of course the market had this kind of double top, and this is the S&P down here in June and July. But that was just before we had that really nasty sell-off in late July, August, and September. And then, of course, the bottom was marked with the transports outperforming. Once again, we have broken down this trend that was in place, and it's only getting worse. You can see it was down again today. Transports really underperforming the Dow by about 1.5% today. So kind of a nasty day, and it's happening on bigger volumes. So again, even though the S&P's hanging out at these higher levels, this is an early warning sign, I think, for some type of correction coming. So the transports were going down, as I mentioned, because of the big spike in oil. Oil 106.25, another big impressive day for oil. And look, it goes back to the Fed keeping interest rates low, pumping more money into the system. You're seeing gold had a tremendous day today. I do have a long position in gold, just using the GLD. It's not a huge position, but it is some to have some exposure. And you can see by the picture oil here, all these non-dollar denominated things are perking up. Oil, gold, and some people look at this chart of oil and you can see it spiked from 104.50 up to over 106, and a lot of it came in the afternoon. Many people believe this spike up in oil is showing that the economy is getting better, so there's more demand. I look at this chart and I say it's happening for a couple reasons. Maybe demand is pretty good, and it's probably because of the Chinese, and some of these other emerging markets. But demand is also good because people are moving out of dollar-denominated or any paper currencies into commodities. So you're getting this inflation in there. And the thing is, there is a point at which this will hurt an economy. Now, in the past, what I have said is perhaps $4 a gallon is complaining and talking about it on the news. What is the actual pain threshold of where people change their driving habits? Is it $4.50? Is it $5? I don't know. But the difference is that now I think the pain threshold is much lower. And the reason why is because the economy is much more fragile now than in the past. So maybe $4 was a complaint level before. Maybe it's an actual level now that's actually going to put a dent in the economy. These higher oil prices, many traders on the street believe, and the chatter is, that this is going to be the thing that causes the market to go down. So, some believe things are getting better, and that's why oil is going up. Some believe it's going up, and it's actually going to be this big headwind translating into higher gasoline prices that's going to hurt the consumer even further. And I'm kind of more in that camp. I think that if this was a good economy, fine. But this is an economy in a stock market that's going up primarily because the better alternative to a 0% money market are dividend-paying stocks, select corporate bonds, gold, oil, things like that. And I think that's why oil is going up more so than demand is just so great. Is there demand in there? Sure. But I think a bigger reason is more speculation, and because of what the Fed's policy is, and not just the Fed, but all the central banks around the world. Remember, the Fed is not the only one in this game. A lot of places around the world are doing the same thing. There's currency debasement going on around the world, and that is causing more and more money flow into some of these commodities. And look, this I think is going to choke off whatever type of recovery there is, if there is a recovery, and it's very lethargic at best. And possibly still, I don't think we're out of the woods as far as saying that this economy is getting back on track. I think it is a Band-Aid that's being put on places like Europe and even in the United States. It's just prolonging the inevitable. And the stock market's reacting because of the fact that, again, what are your options? Right now, people look at a stock in the U.S. yielding 4 or 5%, has international exposure. It makes sense for some people to say, I'm going to earn that money in a dividend-paying stock, especially with the volatility of the stock market so low, as opposed to sitting in the money market. So the Fed's kind of getting what they want. The only problem is I don't think they're doing anything to really help deep down the actual economy. And you can see oil prices here at 106 and a quarter. This is just on the WTI, the West Texas Intermediate. If you look at Brent crude, you can see here, same type of action, a lot of afternoon buying, but this is at, went from 119 up to 121, so this is $121.56. So these oil prices continue to move up, and that's going to be the talk. It's overshadowing Greece right now as well, and I think this is what has a lot of traders in the short run very nervous. Now, what has me a little nervous is more this S&P chart, and you're starting to see, we're overbought. We know that. We've been overbought, but the market has managed to break out to new highs. But you're starting to see various negative divergences building. One of them is, if you look here at this RSI, which is basically the relative strength index, you'll notice that you're getting this kind of negative divergence where you're making a lower high, but the stock market itself is making a higher high. And that is just the first sign that we've seen that we're starting to see these negative divergences. This is just one. I'm seeing a few of them. So, again, I'm expecting a pullback. There's some things that maybe look good to buy. I'm actually have a small short position, as I mentioned the other day, in the Russell 2000. And that's meant to hedge some things, to allow me to keep some things that may be high dividend producing, high income producing, but trying to keep the overall portfolio with less volatility, because the volatility may pick up very soon. But I think a pullback's coming, and I think the oil prices going up as high as they are may be the reason for that. So, anyways, keeping very flexible, still keeping cash, got a short position, got some gold, and just not overdoing things one way or the other here, because the bears have been shredded by trying to short this thing, and the bulls are getting a little too comfortable for my taste. So this is just one thing that's got me worried right here. We've got the oil prices, overbought conditions, and then this one negative divergence that I'm seeing spike up here a little bit. Anyways, I'm going to keep it kind of short today. Thank you all. Appreciate it. CarlEggers.com, Twitter.com/CarlEggers, Google plus Carl Eggers on there, EggersCapital.com for money management. It's all there, folks. Thank you very much. I appreciate it, and we'll talk to you soon.